The world of investing can be overwhelming. With thousands of strategies and approaches out there, it's hard to know which path will lead you to long-term success. But there's one thing every successful investor understands, something that separates the winners from the losers. This one thing is not a secret formula or some mystical technique. It's a strategy that has worked for the most successful investors, including Warren Buffett and Charlie Munger, for decades. Did you know that in the last 90 years, the stock market has seen 15 bear markets? That's 15 times where investors faced huge losses. But guess what? The stock market still ended up making an average annual return of 9–10% over that time. Imagine if you were patient enough to stay invested through those dips. What's the key to not just surviving these dips but thriving in them? It all boils down to understanding the underlying principles that guide value investing. In this video, we're diving deep into the one thing every investor must grasp. No fluff. No gimmicks. Just solid, actionable strategies you can use today to build wealth tomorrow. Stick around because we're going to break down why price isn't the most important factor, how patience can actually make you more money, and why you shouldn't trust the common formulas everyone uses. It's time to stop following the crowd and start investing the right way. Let's get into it. Chapter 1. The invisible factor. Why price isn't everything. When you think about value investing, what comes to mind? Most people immediately think about price. But that's not the whole story. The real power lies in what you don't see, the invisible factors that affect a company's value. It's easy to get caught up in looking for a stock with a low price, but price is just one piece of the puzzle. For example, did you know that Warren Buffett's success isn't just about finding low-priced stocks? It's about finding companies with strong competitive advantages that can grow and remain profitable for years. These advantages are often invisible at first glance, but they matter more than price alone. Think about Coca-Cola, for example. Its brand is a moat that keeps competitors at bay, and that's worth more than a cheap price tag. The key here is identifying a company's economic moat. An economic moat is simply a competitive advantage that protects a company from its competitors. For instance, companies like Apple have this moat in the form of their loyal customer base and ecosystem. This can be far more valuable than just a cheap stock price. One famous quote by Buffett says, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." This perfectly sums up why price alone isn't enough. A company with a strong moat may appear pricey, but over the long term, it will likely generate more consistent returns. And here's the surprising part. Many of the best value investments aren't cheap at all. If you focus only on price, you might miss out on real value. Take Amazon, for example. In the early 2000s, Amazon was considered overpriced. But it turned out that its competitive advantages were worth much more than the stock price suggested. So, how do you find these invisible factors? One of the easiest ways is by researching a company's industry position. Ask questions like, does the company have a dominant market share? Is its brand strong? Do they have any unique technology or patents? All of these contribute to a business's moat and long-term value. In the end, it's not about finding a stock that's cheap. It's about finding a business that will keep growing and earning over the long run. When you shift your focus from price to the business itself, you open the door to much better investment opportunities. Chapter 2. Patience over speed. Why the tortoise wins the race. In today's fast-paced world, it's easy to think that the quickest way to make money is the best. But when it comes to investing, patience is the real secret weapon. You've probably heard the phrase, time in the market beats timing the market, and it's true. In fact, studies have shown that the longer you stay invested, the better your chances of seeing positive returns. Think about this. According to a report by the Credit Suisse Research Institute, the average annual return for global equities between 1900 and 2019 was around 5%. But that return wasn't constant. When you look at long periods, the market has shown its true strength. In fact, anyone who stayed invested in US stocks for 20 years or more has seen a positive return. Patience works because markets are cyclical. They go up, they go down, but they generally rise over the long term. If you try to jump in and out of the market at the right time, you're more likely to miss out on growth. Studies show that missing the best days in the market can drastically reduce your returns. One example of the power of patience is the success of long-term investors like Charlie Munger. He often emphasizes that the big money is not in the buying and the selling, but in the waiting. Munger's investing philosophy is a perfect illustration of how staying calm and patient can lead to wealth. Here's a fun fact. The S&P 500 has historically returned an average of 10% per year, but if you remove the top 10 best performing days in the market over the past 20 years, that return drops to just 4.2%. Missing out on those good days can hurt your long-term results. In reality, value investing is all about buying good companies and holding them for the long haul. The best value investors aren't rushing to make trades. Instead, they're focused on finding companies with strong fundamentals and giving them time to grow. A great example of this is Buffett's investment in Geico. He first invested in the company in 1976 and held on to it, watching it grow. Over time, that patience turned a $45 million investment into billions. Investing isn't a sprint, it's a marathon. By focusing on long-term growth rather than short-term profits, you put yourself in a position to succeed. Chapter 3. The Discounted Cash Flow Myth. The one formula you should stop relying on. Let's be clear. Discounted cash flow, DCF, is often hailed as the holy grail of valuation models. But in reality, it's not the be-all and end-all for value investors. Many investors make the mistake of relying too heavily on DCF, thinking it can predict the future of a company with perfect accuracy. But the truth is, DCF is just one tool, and not always the most reliable. One issue with DCF is that it relies heavily on projections of future cash flows, which can be wildly inaccurate. Even the most experienced analysts struggle to predict future cash flows with any degree of certainty. Small changes in assumptions can drastically affect the outcome. This is why many investors find that their DCF calculations often fail to predict a company's actual performance. For example, a study by Morningstar found that analysts' 5-year earnings forecasts for companies were only accurate 60% of the time. That's a 40% margin of error, and in investing, that's huge. Instead of relying solely on DCF, it's better to look at a range of factors. A comprehensive approach that includes looking at the company's financial health, competitive position, and management quality is much more reliable. This approach gives you a more complete picture of a company's value, rather than just focusing on one formula. One investor who famously shunned DCF was Ben Graham, the father of value investing. He believed that a margin of safety, essentially a cushion between the stock price and its true value, was far more important than any mathematical model. Graham's approach focused on finding companies with strong fundamentals that were trading at a discount to their intrinsic value, rather than trying to predict the future with DCF. Here's the key takeaway. Don't let a formula dictate your investment decisions. Instead, use DCF as one part of a larger toolkit. There's no magic formula for finding the perfect stock. Value investing requires a blend of research, analysis, and patience. In the end, the real value of a company lies in its ability to generate consistent profits, not in a mathematical projection of future earnings. By combining multiple methods and keeping a long-term perspective, you can avoid the pitfall of relying too heavily on any single model. If you're enjoying these insights and want to learn more about making smarter investments, make sure to subscribe to the channel for more actionable tips on value investing. Chapter 4. The Power of Free Cash Flow. Why it's the secret sauce of successful investors. If you're serious about value investing, there's one number you should be obsessed with: free cash flow, FCF. Why? Because free cash flow is the lifeblood of a business. It's the cash a company has left over after paying all its expenses and capital expenditures. Unlike earnings or revenue, free cash flow tells you how much money a company can reinvest in its business or return to shareholders. Think of free cash flow as the money a company generates that isn't tied up in its daily operations or investments. It's essentially what's available for growth, debt repayment, or dividends. And it's often a better indicator of a company's long-term health than earnings, which can be easily manipulated. According to a study by McKinsey, companies with strong free cash flow have historically outperformed those with low free cash flow. In fact, between 1995 and 2014, companies with the highest free cash flow outperformed the market by 10–15% annually. That's the kind of power free cash flow holds. One thing to keep in mind is that free cash flow is especially important during economic downturns. In times of uncertainty, businesses with healthy free cash flow can weather the storm without relying on debt or external funding. Companies like Apple, with over $80 billion in free cash flow, can invest in new technologies and acquisitions without breaking a sweat. But how do you use free cash flow in your investing strategy? First, look for companies that consistently generate positive free cash flow. Next, compare their free cash flow to their market cap, or stock price. If a company generates strong free cash flow but is undervalued by the market, that's a sign you might have found a gem. The beauty of free cash flow is that it's hard to fake. Unlike earnings or revenue, which can be manipulated through accounting tricks, free cash flow is a more accurate reflection of a company's financial health. So, the next time you look at a company, forget about the earnings report for a second, focus on the free cash flow instead. Chapter 5. The Margin of Safety Principle. The ultimate investor safety net in value investing. There's one concept that you must never overlook: the margin of safety. This principle, coined by Benjamin Graham, the father of value investing, is simple but powerful. It's the difference between the price you pay for a stock and its intrinsic value. In other words, it's your safety net, ensuring that even if things don't go as planned, you won't lose everything. The idea is straightforward. Buy a stock at a price that's significantly lower than its intrinsic value. This way, even if the company's performance isn't as good as expected, there's a buffer between the market price and the stock's true worth. It's your cushion, your protection against loss. Warren Buffett, a disciple of Graham's teachings, has said, "The margin of safety is the only protection you have against making mistakes in your investments." This concept is critical, especially in times of uncertainty, like during market crashes or economic downturns. The margin of safety doesn't just protect you from downside risk, it also increases your chances of success. When you buy stocks with a wide margin of safety, you're giving yourself room to make mistakes. The more margin you have, the less likely it is that even if you make a wrong call, you'll lose big. Take the case of Buffett's investment in American Express in the 1960s. At the time, the company was going through a scandal, and its stock price was trading far below its intrinsic value. Buffett saw this as an opportunity and bought heavily, securing a massive margin of safety. Over time, that investment turned into billions of dollars in profit. A good rule of thumb is to look for companies trading at least 30–50% below their intrinsic value. That's the sweet spot where you'll find stocks with enough room to absorb any potential risks while still providing long-term growth potential. By using the margin of safety principle, you're protecting yourself from the unpredictable nature of the market. And even when things go wrong, you'll have a much better chance of coming out ahead. Chapter 6. The Psychology of Value. Understanding market behavior. Investing isn't just about numbers and spreadsheets, it's also about understanding human behavior. The psychology of value investing is all about recognizing how emotions and market sentiment can affect stock prices. Investors often let fear and greed cloud their judgment, leading them to make poor decisions that can hurt their returns. One of the biggest psychological traps investors fall into is herd mentality. When everyone else is buying a stock, it's easy to jump in without thinking critically. But this can lead to buying at inflated prices. On the flip side, during market crashes, fear can make investors panic and sell at the worst possible time, locking in their losses. One of the most powerful quotes about market psychology comes from Warren Buffett. "Be fearful when others are greedy and greedy when others are fearful." This idea is at the heart of value investing. When everyone else is panicking, that's often when you should be buying. And when everyone is euphoric, that's when you should be cautious. Studies have shown that investors who follow their emotions tend to underperform the market. A 2020 study by Dalbar found that the average investor's return was just 4.1% over a 20-year period, compared to 6.2% for the S&P 500. This underperformance is mainly due to emotional decision-making, like buying high and selling low. The key to overcoming market psychology is staying disciplined. Value investors know that the market goes through cycles, bull markets and bear markets, and that panic buying or selling rarely leads to success. Instead, focus on the fundamentals of the companies you're investing in, and ignore the noise from the market. Charlie Munger, Buffett's longtime partner, Puts it simply, the big money is not in the buying and the selling, but in the waiting. Patience and emotional control are essential when it comes to long-term investing success. By understanding the psychology behind market behavior, you can avoid making rash decisions and stay on track to achieving your financial goals. If you found these strategies helpful, don't forget to subscribe and stay tuned for more valuable tips on value investing.